Welcome to The Explainer. So it's August 17th, 2026, and the financial world is absolutely buzzing right now. Why? Because the highly anticipated Lalitha Jewelry Mart IPO has officially opened for subscription today. Our goal here is to decode everything you need to know about this massive offering, really cut through the noise so you can understand exactly what's on the table.
But before we even look at a single number, we gotta ask the big underlying question. Is this the best jewelry stock in India right now? Can a dominant, high-performing regional player actually go toe-to-toe with national giants like Titan or Kalyan Jewelers? Let's find out.
Okay, let's dive into this. We've got a quick roadmap for our analysis today. 1. The Mega Jewelry IPO. 2. Inside the business model. 3. Unpacking the standout financials. 4. Risks you cannot ignore. And finally, 5. The final investment verdict.
All right, Section 1, the Mega Jewelry IPO. Let's get a quick overview of the offering.
1,700 crore rupees. That is the total issue size we're looking at here. It's massive. With 1,200 crore coming in as a fresh issue and 500 crore as an offer for sale from the promoters, this isn't just some small regional listing. This is a heavyweight stepping into the public market.
If you're thinking about subscribing, you've got a pretty tight window. The IPO is open right now, today, August 17th, and it closes on the 19th. The price band is set between 190 rupees and 201 rupees. For retail investors, if you want to secure a minimum lot of 74 shares, you're going to need an investment of exactly 14,874 rupees at that upper band. Allotments are going to drop on the 20th, right before the grand market debut on August 24th.
Moving on to Section 2, inside the business model. How do they actually operate and make their money?
So Lalitha is a true South Indian giant. They operate 61 stores, heavily concentrated across Tamil Nadu, Andhra Pradesh, Telangana, Karnataka, and Puducherry. And what's really fascinating here is their deep regional roots. Get this, 45 of those stores are in Tier 2 and Tier 3 cities, which actually drives over 60% of their total revenue. They absolutely dominate their home turf because they know their core customer inside and out.
And when you walk into one of those stores, it's basically all about one thing: gold. Over 92% of their business is pure gold jewelry. This laser focus is exactly what anchors their astonishing store productivity. Listen to this number. They generate 410 crore rupees in revenue per store. Think about that. That makes them the single most productive jewelry retail operation in all of India on a per-store basis. Now, how do they manage those record-breaking sales? Well, they have this incredibly smart asset-light setup. Out of 61 stores, they actually only own 3 of them. The rest operate on a leave and license basis, which saves them huge amounts of upfront capital. Plus, they tightly control their costs and their quality through backward integration. They run 2 of their own manufacturing facilities in Tamil Nadu, supported by a dedicated workforce of 816 karigars, or artisans. It is just a highly efficient, high-volume retail machine.
Which brings us to Section 3, unpacking the standout financials. And I gotta warn you, these are some record-breaking numbers. Their recent performance, it is literally explosive. From FY25 to FY26, we are seeing a massive 48% jump in revenue, landing at over 25,000 crore rupees. But the real jaw-dropper is the bottom line. Their profit after tax skyrocketed by 177% to reach 1,010 crore rupees. That means their profit margins basically doubled in a single year.
Now, what's really interesting here is the secret weapon fueling all this growth. It's what we call a massive float. Lalitha runs these highly successful customer savings schemes with over 473,000 active enrollees. Through these schemes, they've collected a staggering 5,043 crore rupees in customer advances. To put that into perspective, that is 20% of their annual revenue. It gives them virtually free working capital straight from the pockets of their loyal customers. And this brilliantly illustrates a fascinating valuation story. Lalitha boasts a return on net worth of nearly 40%. That's the highest among all 9 of its listed jewelry peers, beating even Titan at 36.48%. Yet, at the IPO price, Lalitha is trading at a PE ratio of just 11.14x, while Titan sits all the way up at 77.5x. They are being offered at a roughly 75% valuation discount compared to the national players. It's your classic quality at a discount scenario.
All right, time for a reality check. Section 4, risks you cannot ignore. Let's talk about the potential pitfalls. Right now, the gray market premium, the GMP, is pointing to an estimated listing premium of around 13 to 15%.
Models like IPO Gianni are predicting a similar 15.2% pop, so the market is clearly pretty optimistic. But before you get completely blinded by the hype of potential listing gains, we really need to look under the hood at some very real potential pitfalls that analysts are flagging.
Let's methodically break down these red flags. First up, regional concentration. Every single store is in South India, with Tamil Nadu alone accounting for over half of their revenue. So any regional economic slowdown there, it hits them disproportionately hard. Second, they have absolutely zero online or e-commerce presence. None. In a world that is rapidly digitizing, that's a choice. Third, Swastika Investmart flagged a negative operating cash flow of 397.7 crores in FY26. Now that's primarily tied to the heavy inventory requirements for their store expansion, but it's still cash out the door.
But honestly, the biggest concern is exactly how they achieve those incredible FY26 margins we just talked about. You see, Lalith does not have a hedging policy. This means when gold prices surged, those tailwinds flowed entirely into their profit margins, heavily inflating that 177% PAT jump. It wasn't purely operational excellence. This lack of hedging is a really dangerous double-edged sword. If gold prices stabilize or drop, their future margins could take a severe hit. It really begs the question, was FY26 simply too good to be true?
So, what does this all mean for us? Section 5, the final investment verdict. Let's look at some actionable strategies.
Your strategy here totally depends on your time frame and your risk appetite, and we can really split this into two distinct paths. If you are a short-term investor, the play is fairly clear. Applying for a listing gain makes sense. With the current GMP suggesting a 13 to 15% pop, applying for 1 or 2 lots offers low risk for a decent reward. However, if you are looking at a 5-year horizon, things get a lot more interesting. With the ROCE of 42.6% and a PE of just 11x, if the Letha can successfully expand beyond South India and finally launch an online presence, this could legitimately be a 4 to 5x growth story by 2031.
So, the crucial point is, how do you actually manage a long-term hold when those margin risks are hanging over you? The critical strategy is to watch their Q1 FY27 results closely right after the listing. If their margins hold steady at 3.5% or higher, that proves the model is sustainable, and you should probably hold for the long term. But if those margins slip below 3%, you need to book your profits at listing and step away.
Which leaves us with the ultimate question. Can Lalith sustain its incredible margins and successfully expand beyond its South Indian stronghold to become the next Titan? It is going to be a fascinating story to watch unfold. Now, please remember, this explainer is an analysis of the source data and is not CB-registered advice. Always verify with a licensed financial advisor before making any investments. But I know I'm incredibly eager to see what happens when the bell rings for this listing on August 24th. Thank you so much for joining me today, and keep learning.